Hey, good morning, options traders. Well, I thought it would be helpful to revisit actually an old topic, but from a different perspective, to help you understand a very special call and put price relationship that always has to be there. It's not a real difficult relationship, but it's hard to see unless you understand these basic pieces that we're going to talk about in this video. Now, the benefit is that once you understand this relationship, it's going to make you a better options trader just because you will understand strategies better, you'll understand what's going to happen as you switch strikes, and as the stock price goes up and down. So for this video, I just want to talk about the relationship, but just realize that once you understand it, it's going to play a very important role for you in the future. So the first thing we have to talk about is a conversion. We've talked about these before. It's a type of a strategy. And what you're going to do is to buy actually 100 shares of stock. You will buy a put and you will short or sell a call. Those are the three pieces right there. Now, the call and the put have to have the same strike and expiration, but those strikes do not necessarily have to equal the current stock price. So once you put this position on this conversion, it's a type of an arbitrage. It's a guaranteed known outcome. So you can think of it as a risk-free position. So think of it like a treasury bill or a bank CD. You're going to spend a certain amount today and it's guaranteed to grow to a certain future value. So let's take a look at a conversion. Let's say that you buy shares of stock for 100, you buy the $100 put, and you sell the $100 call. So the first question we have to answer is, how much is this package worth today? How much should you spend for these three pieces? Well, because the outcome is known, let's back into it by understanding a bank deposit. Let's say that you need $100 in 1 year and the bank pays 5% interest. So the question we need to answer is, how much do you need to deposit today in order to have $100 in a year? So it's fairly easy to figure out. In 1 year, you need 100. This is what we call the future value. So we're just going to back into it. We're going to take this future value and divide it by 1 plus the interest rate up here, 1.05, and that gives us 95.24. So there's your answer. You'd need to deposit $95.24 today. And to check the math, if you do that, there's your 95.24 times 1.05, and that gives us the required $100 balance in 1 year. So keeping that in mind, let's now go over to a Black-Scholes pricing model. So we're going to make the stock equal to 100, strike of 100, 360 days to expiration, volatility of 20%, and interest rates 5%. And the model tells us that the call option should be worth 1033 and the put 557. So the thing we're trying to figure out is, what's this relationship? Why is the call option so much higher than the put? Is there a little hidden relationship here? Well, there is. Let's go back to the conversion. If you spend $100 for the stock and you spend $557 for the put, right there, and then the conversion says you would have to sell the call, 1033, right there. And so if you do that, you buy the stock, buy the put, sell the call, it's going to cost $95.24. And this will be guaranteed to be worth $100 in 1 year, just like your bank deposit. Now, this is the first piece that's a little hard to see. Why is this guaranteed to be worth 100? Well, take a look at the three individual pieces. You buy shares of stock, you buy the $100 put, and you sell the $100 call. Now remember, you paid $95.24 for these three pieces for this package. Now there's only three different states that the stock can be in a year. It could be equal to 100, it could be greater than 100, or it could be less than 100. So let's check all three of those and see what happens to this position. First one, the stock equals 100 in a year. The call and the put go out worthless. You sell your shares for 100, so you receive 100, and there you go. You paid $95.24 and you cash out with 100. Well, what if the stock price is greater than 100? Well, now the put goes out worthless. You're short this call, you're going to get assigned. In other words, the person that bought that call is going to exercise it, but you're going to receive the strike price of 100. So again, you receive 100, the shares go out of your account, That's what's going to happen when you get assigned. So once again, you paid $95.24 and you collect $100. What happens if the stock price is below $100? Well, now the call option goes out worthless. You're long the $100 put, you're going to exercise it and take those shares of stock, put it off to somebody else. So once again, you've paid $95.24 and you receive $100. So no matter what happens to the stock's price in a year, you're guaranteed to receive $100. That's kind of what's special about this conversion. It's guaranteed to grow to the strike price of the call and the put. So as you're going to find out, as we discovered in the pricing model, the call price always exceeds the put price. This is assuming we at least have positive interest rates. And it will do so by the cost of carry or the interest. In other words, the call price always has to exceed the put price by the amount of interest. So think about what happened in this example. You paid $95.24 and you cash out for $100, which is essentially saying that you earned $4.76 in interest. Well, go back to the pricing model and take a look. Call price $10.33, put price $5.57. If we subtract them, it's $4.76. In other words, the call price is greater than the put price by the amount of interest. How much interest? For the $100 strike for 1 year at 5%. And that amount would be $4.76 in interest. And once again, that's going to be the difference between those call and put prices. So now, how does this help you to understand option pricing? Well, let's go over to a live pricing model and take a look. Okay, so now we are in a live pricing model. These are the same numbers that we used in the presentation. Call equals 1033 and the put equals 557, again for a difference of 476. That's the important point to see. This distance between these, this difference, has to stay the same. So now think about what happens if the stock price rises $1. Well, the call option has to increase $1, but the difference between these options must stay the same. So watch what happens. Let's make this 101. And what's our put option worth? Is worth $5.21. But if we add $4.76 to that, we get $9.97. But now we have to add in this extra dollar's worth of intrinsic value for $10.97. And there we go. That is the price of the call. What if the stock goes to 102? What's going to happen now? Well, if we know the put is 487 and the call has to be at least 476 higher, that gives it a price of about 963 or so, but we have to add in the $2 of intrinsic value. So that call should be trading for about 1163, 1164. The reason they're not coming out exact is I'm not going out to 4 decimals, but that distance, that cost of carry in those time values must stay the same. Now, what would happen if the price drops? Let's say that the stock price goes to 99. What's going to happen now? Well, there's a number of ways to look at it. It's telling us the put is worth $5.94. We know the call's got to be worth $4.76 higher. So that's $10.70, but we now have to subtract out the dollar because the put is in the money by $1. Or you could say the call is out of the money. So we have to take it from 1070 down to 970, and that's exactly what the model is showing. Now, of course, we could work it backwards. If we know the call price, we could work the math backwards and figure out the put price. So let's try that one. We'll do one more. Let's make the stock price 98. And we'll work it in reverse this time. The call is worth $9.10, and we know it has to be $4.76 greater than the put. So let's subtract that out. That gives us $4.34, but we have to add back in the $2 of intrinsic value for the put, and that brings us up to $6.34. So I know it can be a little tricky to see and to understand, but just keep working with it because it will pay dividends once you get more advanced with your options trading. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.